First off, I want to thank our three panelists from the closing panel, from the previous panel, which Ian Gordon, Laura, and Wendy, all of whom have done such a spectacular job along with their respective teams for in piloting the e-liability method across their organizations. And it's thanks to individuals like them, as well as other individuals who have been pilots or led pilots of the e-liability approach, including in organizations like GT Tire, Tata Steel, Heidelberg Cement, and BMW, that we have been able to learn as much as we have on the application of e-liability. When Bob and I first published the original e-liability article in November 2021, we got a call from a senior capital market regulator who had read the paper and was intrigued by what we were saying. And this regulator then looked at Bob and me and said, "So this is a great idea, guys. Who's doing it?" And Bob and I both looked at each other, and then we looked at the regulator and we said, "No one's doing it. We've dreamt it up in our offices." And he said, "Well, that's a problem. You've got to go get some people to try it out." So it was, again, folks like the panel that we just heard from and all of the others that they came from that enabled us to pilot this. And in the process of piloting it, we learned so much about application of these principles in the real world. And it is through that learning that we've been able to produce the first draft of the e-liability proto-standard. The proto-standard is just what it sounds like. It is in something that comes before a formal standard. As we've been talking increasingly to regulators who are considering CBAM and see the need for something that has the properties of product carbon level accounting for an import assessment basis, they've said, well, we can't point to companies and say, do what your papers say. We need to point them to a set of rules that they can then follow. So can you help us write those rules? And so we did, just like with everything else, we put together a team. It was a team of, if we can just quickly move to the next slide, it was a team of 60 people from across what we called a technical working group. These are members of our technical working group who advised us on basically the ways in which e-liability may be applied in different contexts. And it was drawing on their collective wisdom, as well as drawing on the wisdom of my co-authorship team here at the Institute, including Bob and Lauren and Chloe and our summer intern, Max, that we were able to produce the first draft of this proto-standard. As with everything else we do here at the E-liability Institute, the proto-standard is free. People are astonished because even public regulators tend to sell their standards these days, and we don't. We put it up on the internet for anyone to download, as well as for any country to adopt. Even if they don't want to cite us, that's fine. They can just copy and paste and use the language as they must. And so it is produced as a global public good and a free-to-use resource. But it is very much still a work in progress. And so what we would invite you to do is before the 21st of November to write to us if you have suggestions on how this proto-standard can be improved. What we're going to do in this session is Lauren, my colleague, collaborator, and our fearless chief of staff at the E-liability Institute, is going to lead us through the principles that underlie the E-liability proto-standard. And there's a lot of technical detail. I will warn you, it is a dense document. It's not Harry Potter that you will quickly thumb through. But it is a dense document. And so if you're intrigued by the principles, almost every word in the principles has a specific definition. And all of those definitions then have specific interpretation guidance. And that's all in the proto-standard. So our last commenter or questioner from the previous session asked a question that is answered explicitly in the proto-standard. So we'll invite you to read the proto-standard and then, of course, send us your comments and how it can be improved. But before that, let's hear from Lauren. Lauren, over to you.
Terrific. Thank you so much, Karthik. So let's get into the nuts and bolts. So we've proposed 10 key principles in the Proto-standard, which effectively serve to codify the e-liability conceptual approach, as set out in the HBR articles and subsequent publication, as well as leveraging a lot of experience that we gained through working with our pilot organizations and our valued members of the technical working group, some of who are joining us on the call today. So collectively, these principles together set out a system whereby entities maintain environmental ledgers that accurately reflect their emissions, which enables a systematic and scalable way to track and reduce emissions, including in complex supply chains. So today, I'll walk you through each principle in turn, and as Karthik has noted, these are all supplemented by definitions and guidance on implementation, in particular the bolded terms. So I'll invite you to review the standard at your own leisure after this call. So kicking off into things, you see principles 1 and principle 2 there on the slide. So these two principles are really the bread and butter on how we approach direct or scope 1 emissions, as laid out in the original HBR article on e-liability. And there are two key definitions here that focus on primary data, and I really want to hone in on that. And I think it echoes a lot of the insights that we heard in the previous session from the pilots. So the first is that we've chosen to focus on direct emissions in this principle, i.e. kind of those from the activities by the entity itself. And so a key concept in e-liability is that all emissions are measured once and only once, and are done so by the entity that affects them at source. And we really want the emissions here to be linked to the economic activity and the actor. And the second key definition in principle 1 there is direct measurement or calculation. And so what we mean by this is set out in the implementation guidance, but it's twofold. The first is thinking about the use of scientific monitoring equipment, which we see as the gold standard. So that would include, for example, metering devices on a tailpipe. And the second is a calculations-based approach, which takes the greenhouse gas emissions from a chemical reaction or biochemical reaction. So an example could be thinking about calculations from manufacturing processes like clinker or open system biochemical pathways, which is relevant to industries like agriculture. And again, more guidance on both of those is set out in the Proto-standard itself, including what we see as being in scope of direct emissions. And so turning to a few of the other important terms captured by these two principles, by environmental ledger, what we mean is a bookkeeping device to record greenhouse gas emissions. And so this is intended to operate in parallel to financial accounting ledgers, which was led nicely by Christoph's question in the previous session. And so those ledgers can record both the stocks and the flows of emissions in a unit of mass and cover both e-liabilities and e-assets. And I'll just note quickly that this proto-standard only relates to e-liability side of the ledger. And material is another really important word here. And so we've deliberately included this to provide a materiality threshold. And the purposes here are similar to financial accounting. Except in the context of emissions, materiality has a scientific basis. And what this means is that when an entity is determining whether emissions information is material such that it should be recorded on an e-ledger, the entity determines whether that information is relevant to decisions made by a reasonable user. So again, that's providing a bit of a threshold rather than getting too stuck in the weeds. And then again, these principles can apply to all greenhouse gases, and we've chosen to follow the definition of the IPCC. And there's some more detail around kind of how you could transfer that into CO2 equivalents to balance out. Turning to principle 2 quickly, sorry, thanks, Chloe. So the concept of verification is a really, really critical part of the e-liability approach. And you'll see a principle like of this variation pop up again and again as I run you through those 10 principles today. So because e-liability aims to build a carbon accounting system where information is verifiable to the reasonableness standard, this is very much drawing parallels with the world of financial accounting. And so in defining those terms, we've drawn on existing financial accounting and auditing regulations, and again, requiring that verification should be happening at source and be undertaken by an objective third party. And verification is really critical so that e-liabilities and the information that's recorded on an e-ledger are decision useful. And we've heard from the pilots in the previous session around how important that is. So moving then to principles 3 and principles 4. So as 1 and 2 kind of deal with the direct emissions from an entity, these 2 principles relate to the emissions embedded in the goods and goods and services purchased or received by an entity. So your upstream emissions. And as Karthik and Bob have both talked about, the way that works through the supply chain is that those emissions are embedded in the good and that transfers down. So it's kind of every emission is captured at every stage. And so again, the emissions information from that we require to be recorded on the e-ledger, and that is what's captured in Principle 3 there. And Principle 4, again, we've got a verification requirement like in Principle 2. So if we take Principles 1 to 4 together collectively, we see that they cover all upstream and direct activities, which gives us a cradle-to-gate emissions of any product or service in the economy. Very exciting. Moving on to Principle 5. So we know that data availability is a challenge in the status quo. This was something that we touched on in the previous session. So we've also considered what happens where suppliers might not be able to provide the data that's needed or required in Principle 3. So what Principle 5 aims to do there is address that challenge while also addressing some of the current moral hazard issues that stem from reliance on industry averages. Really, we want to incentivize the use of primary data from direct measurement and calculation, and that's what's captured in Principle 1. So in cases where primary data is not provided, we propose that the maximum applicable value, so for example, the 99th percentile value for that product category is used instead. So again, trying to incentivize the reliance on and use of primary data. And this relates really closely to the work that Karthik discussed in session 1 with the forthcoming paper co-authored with Maria Zuber, Michael Wang, and Niels Angle. We need more granular data, and we need that granular data at a product category level and even more granular than that, as well as getting an understanding of the distribution of data in publicly available sources like GREET and Sesame. And those will continue to be a really important part of the picture. And the Proto-standard has some suggestions in terms of how the transition period for this could be managed or how jurisdictions could implement this through a ramp-up period. And then Principle 6, again, this must be verified, very important. So across Principles 1 to 6, they're really about record keeping. So we've got 3 core principles and 3 principles relating to verification. And together these set out the gold standard or the steady state that we want to work towards. So I'll move on next to the last 4 principles, and these relate to the allocations of those emissions that you've calculated and recorded on your ledger to the goods and services, and then how those pass down the supply chain. So Principle 7 and Principle 8 on the slide there consider how emissions are allocated to outputs and the time horizon for this. So we've talked about today a really important concept in E-liability being a full allocation system. So all emissions in must equal all emissions out. And this includes how we think about not only kind of manufacturing or operating emissions, but also the emissions that are embedded in capitalized goods. So think buildings or equipment and how you kind of treat that and allocate the emissions of that. For example, a machine manufacturing widgets, how the emissions embedded in that are allocated to the widgets that are then produced. And it's really important that these allocation decisions are not arbitrary. So Principle 8 requires that they need to be based in a logical deductive reasoning. And this will vary depending on the allocation, but we've set out some principles to inform that in the Proto-standard that I'd encourage you to review. Principle 9, I'm a broken record here, but allocation decisions will also be subject to verification, and that is really important to make sure that we've got consistency across similar industries, goods and services, etc. And very last, and thank you for sticking with me here, I know this has been a lot to digest. Principle 10 relates to how e-liabilities move between entities and their balance sheets within that full allocation approach. So under the e-liability method, emissions travel with inventory or products through value chains all the way to that final economic transfer towards the end consumer. And at this point, what we propose is that emissions are placed on a public ledger for the relevant jurisdiction. So akin to how GDP accounting works. And then this can be aggregated up alongside kind of entity level e-ledgers to create a jurisdiction level e-ledger. And then in turn, those jurisdiction level ledgers can be aggregated up to give global consumption ledgers, which provides accountability for progress towards policy goals such as entity net zero or geological net zero. So that was a lot to digest. Thank you very much. As noted, this is a really technical document. The principles that I've just talked you through are supplemented by definitions, guidance on implementation, and this is where we need your help. So if we move to the next slide, Chloe, thank you. As Karthik has said, this is very much still a work in progress, and we need your help. We want to make this as robust and as rigorous as it can be. And so the call to action here is to please download the Proto-standard, engage with it, review the document, and tell us how we can improve it. I would love to hear your feedback by the 21st of November. You can email us at the address there. We'll circulate this after the conference, and it's also available on our website. And from that feedback, we'll aim to iterate in a new version, hopefully to release before the end of the year. And you have more to look forward to. We'll also be expecting to develop proto-standards on accounting for e-assets or offsets and the disclosure of downstream emissions, so relating to the paper that Bob talked about earlier today. So thanks, and I'll pass back to you, Karthik, and we can open the floor for questions.
Indeed. And let me just say, Lauren, as you probably saw from all of those cheers that went up, you took what would be otherwise an absolutely dry topic, which is to walk us through 10 core principles of accounting, and you brought it to life and with the level of rigor that it needs. And Lauren came to carbon accounting completely new to the subject a couple of years ago when she was one of our first employees here at the E-liability Institute, and is now one of the world's experts in this area. And we're delighted to have her on our team. But let me open this up to the rest of you. And there's a lot here to digest. So we would love to have your questions and your comments on what you've seen. As Lauren has suggested, there is there are rigorous definitions that are based on existing best practices that underline each of those bolded words in the principles, and there's also further implementation guidance associated with it. And whilst you're thinking of your questions, I'll take a first pass at the question that I think it was Umendra who asked at the end of the last session, which is what happens to emissions that are sort of end of life emissions. And that's a great question, Amendra. So there are two things that happen to end-of-life emissions. So first, you think about it in the context of, say, end-of-life emissions with the oil and gas operations that Laura was talking about from Chevron. And there you might have certain capital equipment, that has a particular useful life. And at the end of that useful life, that capital equipment has to be safely broken up and disposed, and in a way that does not cause more damage environmentally. Now, the emissions associated with that kind of disposal of capital equipment is part of your normal course of business. So you would anticipate those emissions, and you would, based on, say, your past activity, and you would then effectively depreciate those emissions over the useful life of that capital equipment. So if you've built some capital equipment for 20 years, that is to say, with a 20-year useful life, and there's some emissions associated with its disposal at the end of that 20 years, then you would anticipate those emissions and you would depreciate it over products that emanate from that 20 years of useful life. If there is some discrepancy between your estimated amount and the final emissions amount, then that discrepancy has to be put into what we call a smoothing balance, and that smoothing balance will then be disposed over a future period. Usually that might not exceed 2 years in order to reduce risks of sort of gaming in that system, but there's a way in which you can account for those sorts of emissions. There's a second type of end-of-use emissions, which are emissions that are end-of-use in the context of consumers. So let's say a consumer buys a product, and after the consumer buys the product, decides to dispose of the product. Now, if a recycler buys that product, then since that particular product is post-consumer use, the recycler is now not accountable for all of the cradle-to-consumer use emissions, because remember, emissions enter the system only once. once because emissions enter the atmosphere only once. So all of those emissions from the first consumer use cycle are effectively already accounted for in that global e-ledger that Lauren referred to. So those consumer use, so when the consumer buys a product or disposes of a product and it enters into, say, recycling, then the recycler will only account for fresh emissions from the recycling process. Let's say that the consumer disposes a computer and the recycling company wants to harvest from that computer things like copper, because that copper is quite valuable, but it needs to incinerate a plastic circuit board in order to harvest that copper. Well, then they're going to have to account for the emissions from the incineration of the plastic circuit board, but they're not going to have to account once again for all of the emissions to make the computer from scratch, right? So basically, the accounting resets once it hits the global environmental ledger. When there are emissions incurred from consumer use, this is to say that emissions from, let's say, a consumer buys a particular product, like an internal combustion vehicle, and then the consumer is using that vehicle, and then that vehicle consumes sort of fossil fuels, then those emissions are the downstream emissions that Bob was talking about in the very first session. Those consumer use fossil fuel emissions would not be on the fossil fuel suppliers e-ledger. Those emissions would directly make it on to the jurisdiction's e-ledger, because basically consumer emissions of internal combustion engines from internal combustion engines for personal consumption use are emissions that are directly attributed at the global e-ledger or the jurisdictional e-ledger level. Of course, companies can voluntarily disclose those emissions or even mandatorily be forced to disclose those emissions based on what the jurisdiction's policies are. And finally, there may be some emissions from the destruction of consumer equipment, which is not part of recycling processes. So let's say you sell your used car, the used car has to be junked. That junking process requires certain emissions, and that is managed by the recycling in that jurisdiction. Then those will, since it's effectively managed and paid for by the recycling entity in that jurisdiction, those would be government-related emissions, or whichever jurisdictional authority is managing that. It's not a recycling process, sorry, it's a waste management process. Whichever recycling entity or governmental entity is managing that waste management process, the emissions from that will sit on their ledger. They might, of course, subcontract to a waste management company, and the emissions will transfer through that company's own ledgers, but that's how that would work. So each of those cases are dealt with specifically and distinctively, and those details you can find in the Proto-standard. Again, that's quite a conceptual view of it. I've got MS has their hand up. I can't see who MS is, so MS, if you can, is it, oh, let's see, who is it? It's, oh, is it Mike? Yes, hello, Mike, yes. So Mike, can you turn on your camera and say a word about where you're from and then ask your question?
So my camera should be on. Can you not see me?
It is on now. Yes. Yes.
It is on? Okay, excellent. Yeah. Yeah. So thank you so much. My name is Mike Sabo. I'm with SAP. I'm a colleague of Christoph. And I work on a product which is called the Green Ledger, which is supposed to support our companies, our customers to put all of this into practice and basically do all of this in not on Excel sheets, but in the ERP system. And we're working on this pretty much since you guys put out that paper in 2021. So that paper, greatly inspired also us to get on this journey, and we've come a long way. So thank you so much. It's a great conference. I've learned a lot, and it's really great to see all these pilots and all these great thoughts being added to the conversation. So I would like to put out a question, which is a very practical question we are dealing with, and I'm just doing nothing else, just putting together some of the things that were already presented here, and I'll put ourselves like 1.5 years into the future. So the question relates to CBAM, so the European version of the CBAM, which will go into effect in 2026. which will simply mean that emissions will cost money, a lot of money, in fact. So the numbers that are floating around are very scary to impressive. So importing any of these CBAM products into the EU will cost a lot of money, which means we will have a financial accounting topic to deal with. So we will be putting assets and liabilities on the balance sheet, like good old financial accounting fashion. But the question I have goes more to the carbon accounting and carbon measurement piece of this challenge. And the background is simply that in the meantime, we have multiple carbon measurement frameworks out there. One of them is, of course, the Greenhouse Gas Protocol corporate standard with its scope 3. And we've heard a lot about the weaknesses and problems of the double counting and all of that. But it's just a matter of fact that many companies will now start applying that, and they will start measuring emissions. For example, let's take a company, a European company is importing steel into the EU today. So that company today will measure that business activity as a scope 3.1. Let's just put a number on top of it. Let's say that's 5 tons for importing 1 ton of steel. And now comes CBAM, it's around the corner, and then we are studying all of the details of it. And what the CBAM tells us is that when you measure the carbon content, then you should use exactly the same method as the European manufacturers do, which is, I'll call it the EU ETS method. So they even use the term embedded emissions. And there's no such thing as scope 1, 2, 3 over there, but they do talk about direct and indirect emissions. So what they're basically saying, if I put that into the terminology of the Greenhouse Gas Protocol, they say take the scope 1 and 2 emissions of the manufacturer, add in the direct emissions of shipping, and then that's going to be the basis. That's going to be the taxable basis. And just to put out a number, that number is maybe 2 tons for that same business transaction. So the problem we are facing right now is in 2 years from now, or 1.5 years from now, when I put this into my accounting books, I have a measurement problem. Because if I use the Greenhouse Gas Protocol framework, I have to put 5 tons into my ledger for importing that 1 ton of steel. But if I apply the CBAM method, it's going to be 2 tons. And I'm pretty sure most people will say, well, the 2 tons have to go in because I have to pay a tax on that. So there's going to be a lot of other financial postings. But what we are now in front of is what the financial world called the parallel accounting issue. And we all know, so those of you who are in finance know that certain transactions have to be recorded on a local GAAP basis and on the corporate or consolidated group GAAP. So you do have this parallel accounting.
Okay, so I think we get a sense of the question, Mike, or do you want to sort of quickly converge this to a question, just because I'm also watching the clock.
The question is, we are not really wanting to go into a parallel accounting world.
Yeah.
But what we're thinking right now is we're going to measure that based on CBAM, 2 tons, put it in the ledger. And in this case, we will not see that 5 tons on.
Okay, got it. So let me quickly address this. This is a really important question. I'm so glad you brought it up, Mike. There's only one accounting. This is why I said the distinction between accounting and disclosure is really material here. There's only one accounting. There's only one way to think about the embedded emissions in any product or service. And this is effectively, I mean, we call it E-liability. You can call it whatever you want. You can call it goose and gander. But there's only one way to do it, because effectively there's only one way in which, you know, the emissions, the beauty of carbon accounting is that you're counting something from the natural world. You're counting actual moles of CO2 that went into the atmosphere. So there is a right answer here. And the whole idea is to get to that right answer, right? And that right answer has to be consistent, again, as I started this conference, with the first law of thermodynamics. So basically, there's a right way to do this. There's a right accounting for this. There can be lots of disclosure-based social constructs over that, which is sort of when you might engage in, say, overcounting or multiple counting. You might count downstream emissions as part of a way to increase accountability of an entity, et cetera. But that's not accounting. That's disclosure. There's just one way to account for the embedded emissions. The way the CBAM is currently approaching this is unsustainable. And I've written about this in an article for Impact Alpha. Chloe might post that in the chat. It's unsustainable for the following reason. It has certain things counted, but other things not counted, right? And that is sort of like the same mistake that we would sort of fall into, or the same trap we would fall into if we were to use something like scope 1, scope 2, scope 3 as a taxable basis, because it is arbitrary. It is not consistent with the laws of thermo. So they've said, oh, certain upstream. Now, they are not talking about downstream emissions. They're just talking about upstream emissions and direct emissions. But they're saying certain of these upstream emissions matter and others don't. So for instance, in another jurisdiction where they're writing CBAM, they don't want domestic transportation to count. So, right, they're saying, oh, domestic transportation emissions don't matter for CBAM. That makes no sense because the emissions are going into the atmosphere. So there's only one way to account for these things, and that's the true way, the natural way to account for it. And we should start with that. The moment governments start creating these kinds of exceptions, now there might be politically salient reasons to do that because there's a powerful industry or lobby group in a particular jurisdiction that's asking for the exception. But the moment they do that, they create incentives to walk around those rules, right? And the government cannot possibly anticipate all of the ways in which those exceptions can be. So unless they embrace a full accounting approach that's consistent with the laws of thermo, they'll get into real trouble with this. And Europe might learn this before they make the mistake. We've written about it in public domain, as with everything else, it's in the public domain. And we hope the people who are writing CBAM in Europe are reading that piece. But they might learn about it that way and avoid making the mistake. Or they might learn about it the hard way by making the mistake and then saying, oh my God, this doesn't work. And in 3 years, we'll see it corrected. But there should be no debate about what is the accounting for a product or service, because that's the beauty of this system, that it has to conform to certain natural laws. Now, with that, I see there's one more hand up. But we are coming close on time, and I want to leave a little time for Bob and me to just close the conference. So thank you, Mike, for that question. And Bob, I'm going to turn it over to you to offer some closing thoughts, just with the view that you give me a couple of minutes at the end. And leave it to your discretion if you want to ask, let that last question in as part of your closing comments.
Yeah, well, I made my observation at the end of the previous session. So let me let's hear the question and hope it's you can express it relatively succinctly.
So it's Ang, yes. Ang, ask a quick question and tell us who you are.
Sure. Good evening. So my name is Cameron. I'm part of a charity organization and volunteer called the Shifters, a French charity regrouping 20,000 volunteers across France and the world. I'm also part of, within that group, of a carbon accounting task force, which we have launched following the principles of the E-liability Institute, actually. And we are very much moving forward with a couple of pilots, but notably also we have started to attract a lot of, let's say, interest from professional bodies, notably towards the accountants and auditors at a national level. And we're starting to move quite fast with them. And the question I have is that now that we are really basically entering completely new waters when it comes to the question of, let's say, standardization of methodologies, systematization or regulation, we're starting to wonder, okay, what's the best way to go about it? And I was a bit curious to hear your thoughts about what was your vision when it comes to, pushing forward with the principles, with the methodologies to make it become firmly established standard in the near future.
I'll take that as part of my closing comments, but first to you, Bob, please.
Yeah, so one observation I had, and it gets back to our online dialogue about the compatibility between Scope 2, Scope 3, and E-liability accounting. Obviously, Karthik and I think very the same on this. But just as an example, several in the case studies in the previous hour was showing the diagram which the Greenhouse Gas Protocol puts out. And the diagram shows Scope 2 and Scope 3 emissions going in the atmosphere. This is a false diagram. I mean, Karthik made the point just before that the only emissions that go in the atmosphere are scope 1 emissions, or what we now call direct emissions. And the role of the accounting system is to measure and trace and hold accountable all the scope 1 emissions that are occurred to deliver a product, produce a product or a service. Full stop. So any approach which shows scope 2 and scope 3 emissions somehow going in the atmosphere and contributing to climate change just is not right. So when Karthik says there's a right way to do it, that's what we're talking about. The goal of this is to just try to reduce the quantity of scope 1 emissions going in the atmosphere. And the E-liability system ledger traces those. And even though there's only a single accounting, we're only counting it once, there's multiple accountability. So people are getting confused between the two terms, which are very similar. We're accounting for the emissions only once, but every company downstream in that supply chain has made a decision to purchase the product which has those emissions that were produced in order to get there. And so we embrace multiple accountability. In fact, the system does exactly that. But you count it once and only once. And it's going to be audited where it occurs. That's the only place you can possibly audit it. And fortunately, companies, Green Ledger at SAP, are going to provide us with a system that enables us to work at scale as a universal system. Karthik,
Thank you for that, Bob. That's a very powerful way to close. Let me sort of offer a couple of remarks on this question of theory of change, because it comes up a lot right now, and it is absolutely essential to what we're doing. That's why, in fact, we created the E-liability Institute, because we've got the underlying conceptual ideas, we've got a proto-standard, we've got case studies, and now the question is, how does this go into practice? Now, we obviously have no authority. We are professors, university professors, and we can't create standards for the rest of the world. What we can do is drive knowledge into the public sphere. And there are certain pull factors that are really consuming this knowledge at a very sort of promising and an increasingly accelerating pace. And I'd say that the largest pull factor right now is, in fact, CBAM, right? Regardless of what happens in the US elections in the course of the next few weeks, economic nationalism will be here to stay in the United States as well as across the world. And with that economic nationalism will come a greater desire to ensure that goods that are imported into a jurisdiction are imported on a fair basis, so that effectively domestic competitors or domestic manufacturers are competing with the same environmental laws or on the basis of the same environmental laws as overseas competitors. And the idea is to raise the stakes of the game so that we can use that import-export basis as a way to also decarbonize the planet. So if you can say, let's use the cleanest jurisdictions and the cleanest production techniques in the world to raise everybody else's game, then we accelerate the path to decarbonization. And that's what a CBAM can do. Now, for a CBAM to do what it needs to do without upending the global trade system, without ending globalization as we know it, it cannot be discriminatory against a particular jurisdiction. You cannot say, for instance, write a bill that says, whether it's, say, the United States or Canada, all imports from China are dirty. That would be violating, firstly, that would make no sense. And secondly, that would be violating the premises of the WTO agreements. But if you said, well, a bar of steel imported into the jurisdiction will be assessed on the basis of its increase or its excess over domestic production, then that ensures that you are A, raising the game of domestic production if overseas production is cleaner, or B, you are basically increasing the efficiency, the environmental efficiency of the overseas producers. So that's a way in which this kind of accounting system will allow you to A, decarbonize the planet, and B, stick to the existing protocols of the World Trade Organization, stick to effectively the World Trade System as it's been created. And that can be a win for the people who are concerned about domestic jobs, the economic nationalism forces. It can be a win for protecting world peace because of the impact that globalization has on creating strong commercial bonds, and it can be certainly a win for the climate. So that we see as perhaps the strongest pull factor today, pragmatically, in the space of something like the rigorous product level carbon accounting that we're talking about. There are other pull factors, but that's the one I'm going to emphasize and close on. And then in the final minute, I just want to say a huge thank you to all the members of our extended stakeholder community, 67 of whom are on this call, but there are hundreds more who are part of our mailing list. There are over 1,000 people that regularly engage with the Institute, notwithstanding its fairly technical sort of subject matter. And I also want to particularly thank the members of our board, our advisory board, and our staff. So on this call, we've heard from Lauren, our chief of staff, but the person who has been making the back end of this conference work is Chloe Zhang. Chloe, if you can just unmute and say a quick hello so that everyone can see you, that would be wonderful. But Chloe and Max, and there's a whole host of staff volunteers. There we go. Thank you, Chloe. There's a whole host of staff volunteers that make this, volunteers and employees that make this work, and we want to acknowledge their work as well. So thank you, Chloe. Thank you, Lauren, and thank you, everyone else.
Okay.